Our first speaker this morning is going to be Dr. Bob Murphy, and he's going to be talking about banking. Bob?
Thanks, everyone. It's kind of funny. It seems like there's a lot fewer people in here now at 9 a.m. than there were yesterday at 4. It's a mystery. I'll have to explore why that's the case. All right, so I'm talking about banking. Let's see if I can do this right. Okay. So what I'm going to do is, first of all, let me just take a step back and make sure you see the big picture of what we're going through here. So far you've learned about money. I taught you about capital and interest yesterday, and then now we're doing banking, and we're going to see how the bank system in conjunction with the central bank, and we'll talk about that in a minute, expands the amount of deposits or the money supply, basically. And so we'll see how the banking system itself, under what's called fractional reserve banking, and I'm going to define all this stuff if you're unfamiliar with these terms, how that affects the rate of interest. All right, so this is all building up to Roger Garrison's talk, which is, this is next, talking about the theory of the trade cycle, or what you probably know as the business cycle. All right, so let me, again, I just want to give you the bird's eye view to make sure you understand where we're going with all these lectures, that after Garrison's lecture, you'll understand Mises' theory of how it is that the business cycle is not just characteristic of the market economy. Right? So a lot of free market economists think that. Like if you read Milton Friedman, for example, I don't remember the exact phrasing he uses, but it'll sound as if, just market economies, they have their wild up and downs, and the government really shouldn't play too big of a role because that's just natural, and shouldn't try to fight it because that's just a natural thing. The Austrians don't think that. The Austrians say, no, the business cycle is itself caused by government intervention. All right, so there's a few components to that explanation. So what Garrison's going to talk to you about in the next lecture is how tinkering with the interest rate messes up that intertemporal coordination that I talked about yesterday, right? That the interest rate helps coordinate consumers, their spending decisions and their plans about how they want to time their consumption. Well, the producers have to be getting signals or something, right? The producers have to, when they're deciding how much investment to put in a certain line, whether we should build a factory or whether we should build a restaurant, they need to have some sort of guidance. There has to be some mechanism by which the consumer's preferences for consuming a little bit right now or postponing consumption and consuming more down the road, there's got to be a way that those preferences sort of affect what it is that the producers are doing with the capital structure. All right, so that's the primary thing that Austrians think the interest rate does in a market economy. And so Garrison's going to talk to you about, what happens if the interest rate is pushed down too low. But what he doesn't really get into, because he's got to deal with that topic, what we're going to talk about today right now is what mechanism happens, how is it the case that when we say, the Fed cuts interest rates or the Fed slashes interest rates, how exactly does that happen? So that's one of the things we're going to talk about in this lecture, and we'll see it has to do with what's called fractional reserve banking. But before we get into that, let me just give you sort of the pure theory of banking in a totally free market Rothbardian world. So there's two different types of banking. The first type is what's called a demand deposit, or what you probably think of as a checking account. All right, so demand deposit, that term, what it means is that the funds are available upon demand. All right, so what you're doing there is you're just putting your money in the bank. The bank is acting as a warehouse. All right, and so let's just think through a minute, what's the economic function of that? Why would anyone use that? Well, even if we're thinking back in terms of the people using gold and silver as money, what Doug French was talking about, that's probably what would happen in a pure market economy where the government didn't get involved. So people are using gold and silver as money, and we understand the tremendous advantages of that, right? That you avoid the problems of barter, the double coincidence of wants. That problem's easier to solve, right? The idea that if you're a dentist and you are hungry in a market economy, if there weren't money, you'd be in trouble, because then if you wanted to get food from somebody, you would have to hope that there was some butcher out there who had a toothache, right? So that's, I mean, you just think through examples like that. Or if you're a school teacher, again, if you wanted vegetables, you would have to hope that there was some farmer who had a kid that needed to learn how to read, right? Otherwise, you'd get scurvy because there'd be nobody paying you to teach their kid how to read, right? So you understand that's the problem that money helps to solve, that because there's one or few goods that are universally accepted on every side of a transaction, that's what money solves. But that's not enough, or I should say there are still limitations to that. So if you just think through some of the problems, okay, let's say we're using gold as money, and that's great, and it's divisible, and it's storable, and all the nice properties Doug French talked about. But still, if let's say you're a wealthy merchant, and you have just thousands of pounds worth of gold to your name, and that's the way you're storing it, that's kind of risky. You don't want to just have that in your house, or you don't want to, if you have to go do some huge deal where maybe you're going to buy a bunch of cargo that's going to go on a ship across the Atlantic, you don't want to have to go down to the person's office downtown and literally have like a horse carrying a bunch of physical gold, right? Just hundreds of pounds of gold, because that would be unwieldy. So that's one of the functions of just pure checking accounts or demand deposit accounts, is the bank acts as a warehouse. So instead of having to carry around the physical gold, what you do is you deposit it at the bank. And so just thinking through, why is that useful? Well, because there's economies of scale. Instead of having 1,000 people in the community having to buy little safes in their house, for example, and use that as the way of safekeeping their money, there's one central depository where they build a really almost impregnable safe, and they have armed guards, and they have security cameras and so forth. And so it's cheaper per unit of gold to guard that way. And they can take out insurance and so forth. So even if they are robbed, they can get the money back that way. So that's one of the functions. And so there, what you're doing, you put the gold on deposit, and then how do they let you know, or how do you prove that it's your gold? Well, there's various ways you could do it, but back originally, what they would do is give you what's called a banknote, right? So it would just be a certificate that a particular bank would create, a piece of paper that would have fancy markings on it and so forth, so it would be hard to duplicate. And it would just say the bearer of this note can go to this particular bank, any of its branches, and turn it in and get whatever the thing says, 1 ounce of gold or a gram of gold, whatever the denomination is. All right, so that's the function of a pure checking account. In more modern times, and what they started doing originally with wealthier merchants that could be trusted, but now it's just commonplace, is to give somebody a checking account. So instead of giving pre-printed coupons or claim tickets to go into any of these branches and get gold or whatever the money is in the community, instead they'll give people checkbooks, and then they can go around writing checks. So like I said, originally that was only a privilege of really respected wealthy merchants whose credit was nobody was worried about. Whereas like if some regular guy tried to write a check, they'd be afraid that it would bounce. They would be afraid to take it. So originally people used banknotes, and again, if you're trying to think of it, it's hard to even convey that, because now that seems so foreign to us. It's sort of like when you go to a bank, you get like a money certificate from a bank. You go, like if you have to get something official, like a lot of times the government will insist you can't just send them a personal check, right? So you go to the bank and you get something that's real official looking, and what it technically is, it's the claim on that bank, right? But it's not really a personal check. So that's the only thing I can think of that you may have encountered in your daily life to sort of convey that. But nowadays, of course, what people use is a check. And think about it, what is a check? It is just saying, it's the bank gives you these pre-printed things saying when you pay for something that if you send this in, my bank promises to, assuming I have enough money in my account with them, will transfer money from me to you. All right, so again there, it's just a matter of the bank is acting just as a warehouse, and it's just transferring ownership. So if it's clients of the same bank, it's really simple, right? If I go and write a check for 1 ounce of gold and buy some items from a merchant, and then he goes and deposits at the bank, and we both are clients of the same bank, well, then the bank on its books just deducts an ounce of gold from my account and adds it to that person's account. So it's pretty simple. It gets a little more complicated if we're members of different banks, and we'll talk about that in a minute. So one thing to notice here is if we have what's called 100% reserves, and I'll flesh this out in a little bit, but just for right now, I want you to realize if you have 100% reserves, meaning that at any given time, people are walking around either with banknotes or how much they think is in their checking account, if that money is all fully backed up by actual real money in the bank vault. So if we're using gold, you look at all the bank's customers and they're walking around. This guy, you say, hey, how much is in your checking account? He says 5 ounces. You ask this guy, 10 ounces, and so on. And you do that for every single customer of the bank, and you add up that number. That's how much physical gold is in the vault. So that's what 100% reserves mean. If that's the case, then how is the bank making money? Well, it has to charge a fee, right? Because the bank's not, I'm jumping ahead here, the bank's not lending that out. So the bank isn't putting your money to work for the bank, it's just physically storing it. That's the function it's serving. And just like any other warehouse operation, it's going to charge you a fee, right? So it's kind of funny because I'm anticipating here, but Rothbard's view, as a lot of you know, is that 100% reserve banking is the only proper kind. And a lot of people, when they hear that, they say, well, that obviously wouldn't work. How could a bank stay in business? But I mean, when you are in college and you go back home for the summer and you put your stuff in storage, obviously that person who owns the storage facility is able to stay in business. And how does he do it? Well, because he charges you a fee for it, right? It's not that he takes some of your couches and loans them out to people. And then, just says, what? And then if you got mad and you came back and you said, whoa, where'd my couch go? He said, well, how can I stay in business? I need to loan your couch out. I was expecting you back in September. All right, so that's, clearly that's how checking accounts or demand deposits would work under 100% reserve. So it would work. People would still be willing to pay for the privilege of having this really safe institution with big safes and armed guards and so forth guard it. And then even in modern times, ATM machines. That's another thing that's kind of funny. People get mad and they say, like, I can't believe the bank is charging me to use my own money. You say, what are you talking about? So this ATM fee. But if you think about it, what the banks have done is it's like you have this magic wallet that just goes around with you wherever you go. And any city you go to, there's your money sitting right there in this really safe thing that you need to know a 4-digit access code to get to. Right, so that's kind of amazing when you think about it. Those things are just built there, they're all over the place, and they're all stocked with money, and they're just waiting there for you at your convenience. And a lot of times, you don't even have to walk 2 blocks to get it to it. And yet, a lot of people are outraged. I can't believe they're charging me $1 to do that. So anyway, that's the rationale, and that's how, if every bank in the economy were 100% reserves, they would either be charging you a direct fee, and we don't know exactly how it would work because it's a market economy. It depends. They would use competition, and different entrepreneurs would come up with different ideas. But they might do something like charge you a small nominal fee every time you use a check, or they might do like a fraction of your total balance every year. They might just give you some sort of fixed hit, or they might charge you a fixed dollar amount per month or something. We don't know the exact pricing mechanism or plan, but the idea is they clearly, to cover the cost of hiring the guards and having the tellers there, and if they have ATMs to do that, they need to pay for that somehow, and that's how they would do it. They would charge you a fee. They might roll it into, if the bank, we'll get to in a second, is doing other things, they might roll the checking account in, so that's sort of like a freebie that they do on the side in addition to all the other business they're doing with you. But even there, on the books, they have to pay for that somehow, and they're just accounting for it in other parts of their operation. Okay, so the other main type of banking operation is a time deposit, or what you probably know of as a savings account. So here, and this is probably what the general public sort of thinks of it when they think of banks, and what do banks do? Why are they good? The bank acts as a credit intermediary, right? A middleman, if you will. And so what happens is you've got people who want to save funds, and they go and they give it to the bank, and they get paid a certain interest rate. So they're making a loan to the bank, and then the bank turns around, takes those funds, and loans it to somebody else in the community. And so that's the sense in which the bank is a credit intermediary. It's in between the ultimate savers and borrowers, and the bank is just sort of moving the money around. It's just connecting people. There's a bunch of borrowers over here. There's a bunch of savers. There's a bunch of borrowers, and the bank is in between those two, taking loans from the savers and then advancing the loans to the borrowers. And the bank charges a higher interest rate to the people who borrow from the bank than it pays to the people it's borrowing from. And that's how that spread is how the bank makes its money. So again, this is perfectly fine in a Rothbardian world. This is there's nothing illegitimate about this. The crucial distinction between the time deposit or the savings account versus the demand deposit is that in the second one, the person who lends the money to the bank, that's not his money anymore. Okay, he has surrendered his control over that money, and instead he now has an IOU. So it's a credit transaction. So for example, if the bank has a CD, certificate of deposit, that pays 3%, a person might go and buy a 12-month CD. So he gives, let's say, $1,000 to the bank, and then the bank gives him this formal legal document that's a claim saying, 12 months from now, we will pay you $1,030, okay? And so he's giving up $1,000 now, and then in a year, he's going to get $1,030. Now, if he wants to, like if he runs into hard times and he needs cash, he might try to sell that CD to somebody else in the community, but the point is it's not entitling him. The bank doesn't owe him that money until a year from now. That's the crucial point, depending on the wording of the contract, but that's the idea that he has surrendered, so that's not his money. So when he's walking around deciding, I'd like to buy some things, he can't just say, oh, well, I gave some money to the bank and say to a merchant, just have the bank give you some of that money that I gave to them the way he can with a checking deposit. With a checking account, again, remember, the person's walking around, he sees something he wants from a merchant, and he just writes and gives it to him and says, I've got this, I'm good for this, I deposited that money last week, it's sitting in the vault over there, so here you go. You show this to the bankers, and they'll give you part of my stockpile. You can't do that in a Rothbardian world with a time deposit or a savings account because the bank's already lent that money out. The bank doesn't have that money. It's not sitting there with your name on it, whereas it really is sitting in a drawer somewhere, in a sense, with your name on it under a 100% reserve checking account. All right, so that's the function of time deposits. Now let's just, in terms of the economic rationale, why is that useful? We've talked about checking accounts and why that helps in terms of safety and that you're not going to get robbed as easily if you put your money in with the bank, and just the convenience that you don't want to go to town if you're going to make a huge purchase, having wagons full of gold being carted around, that it's easier to go and just give a piece of paper. But what function does this credit intermediary operation serve? Well, just think about it. You've got people in the community, let's say there's this young couple and they want to buy a house and they don't have the money for it right now. But they both have jobs, they've got a nice future ahead of them, they think they're going to have these productive jobs for a long time. And so they would, given their time preferences and so forth, they would be very willing to get a house now in exchange for surrendering portions of their future paychecks that are far in excess of what the dollar amount is or the gold ounce amount is that they're getting in the present. Okay, so they'd be willing to trade away a greater amount of future goods in order to get a lot of present goods right now. And so the idea is they want to go borrow money. So that's perfectly fine. That makes sense with their preferences. They have time preference, okay. And at the same time in the community, there's a bunch of people that are in their 40s and 50s, and they're the opposite. They are already in a comfortable house. They're in their prime working years. They're earning a bunch of money from their jobs, and they want to provide for their retirement. So they would be willing to give up a lot of their potential consumption right now because they want 30, 40 years down the line, they want to have more consumption flowing at that point when they might not be working. And so obviously there's, let's make a deal, there's gains from trade here, right? That the intertemporal preferences of those two groups align so that there's gains from trade. But the problem is, I'm going to use dollars because that'll be easy for us to think about. Let's say the couple wants to buy a $200,000 house, and they would be willing to pay 5% interest on that for a 30-year mortgage. And let's also say there's 2,000 people in the community that are each, or let's say 200 people in the community that are each willing to invest $1,000. Like that's how much they're going to put aside this year in their savings. You would think, oh, well, those people the couple should just get the $1,000 from the 200 savers. That's the 200 grand they need to go buy a house. But in reality, that wouldn't happen. If this, couple's going around knocking on people's doors like, hey, I'm Jim down the street. Well, he wouldn't be down the street because he doesn't have a house. Hey, I'm Jim. I'm under the bridge over there, and I want to get a house. This is my wife. Look, I really do have a job. Here's my badge to get into my factory, and you can call my boss if you want. But I hear you want to save $1,000, so can I have it? And I'll sign a doc. I'll sign all sorts of things you want to prove to you that I will pay back that loan. And they're going to go up and hit up 200 people that way. That wouldn't work because, think of it from the individual saver's point of view, if that guy happens to lose his job, or if he skips town, but even if he's an honest person but just gets laid off or gets hit by a bus or whatever, dies from heat because he comes down to Auburn in the middle of July, then he's not gonna be able to pay back that loan. And so the savers, who are building for their retirement, they might lose their whole nest egg, right, in one fell swoop just because one particular guy or his wife loses their job or gets sick or whatever. So it would be very risky to engage in these sort of bilateral savings and lending transactions. So what does the bank do? And this is obvious to you guys, but I want to spell it out. So the bank, of course, is the middleman in that operation, and so all of this, there's thousands of savers in the community that give $100 a month or $1,000 a month or whatever it is into the bank. And then the bank has a lot more than $200,000. It has millions of dollars at its disposal that it needs to then put to work in the community by finding worthwhile projects. And then the potential borrowers, so people who are looking for a mortgage, but also business people that want to get a loan, they go to the bank, and the bank has experts, and their job is to evaluate the creditworthiness of potential loan applicants. All right, and so that's the idea. So there's a couple things, there's at least two different things going on there to show how it is that the bank promotes efficiency or allows people to reap the potential gains from trade there. One is that the bank, it's through specialization, that the bank's loan officers, at least in the textbooks, are going to be better at judging credit risks than just the average person, right? So they're going to know that. And again, it's kind of funny saying this in the wake of what has happened recently, but so the story goes, the bank's loan officers aren't going to just allow someone to buy a $200,000 house who doesn't have a job. And they're going to, make sure that they're going to take care of the bank's money and make sure that, okay, if you're an applicant, we're going to check you out. And if somebody is a risky prospect, they're going to charge a higher interest rate. All right, so again, on the one hand, there's the idea that the bank, its personnel that's their business. They're in the business of evaluating credit risks and making sure that people, if they say I've been in a job this long, maybe they check it out or they go look at the credit score. Whereas the individual saver, the person who just wants to put away money for his retirement, he doesn't want to get into the business of evaluating credit risks like that. That's not his forte. He doesn't, he's not good at that, and he would be a lot more squeamish than the banker who, again, in theory, has been doing this for years and knows what they're doing. And then the other thing, of course, is just putting everybody into this pool. It sort of spreads the risk around. So the fact that loans are made through the bank, that doesn't eliminate the chance that the guy's going to get hit by a bus or skip town or get laid off from his job. But the idea is that the brunt of that is not going to fall on just one particular saver. It gets spread across the entire pool of the savers, and the bank has taken that into account when it made the original loan and charged the interest rate accordingly. They took into account the fact, like if it's some business venture that has a chance of really being a home run, but it also might collapse, they may charge them a higher interest rate than if some real reputable, stable firm just wants to borrow some money to do something that's pretty straightforward, just to expand their operations or whatever. And the bank knows, they're going to be able to pay this back. They'll charge that borrower a lower interest rate. Okay, so the idea, it's sort of like an insurance company. which I'm not going to talk about now, but if you understand how insurance companies work, it's that sort of principle is one aspect of what goes on in how a bank promotes economic efficiency in this respect. All right, so those are the two main functions of banking. And an important point is that so long as there's 100% reserves, the banking per se does not create new money. So with checking accounts, again, if they're 100% reserves, that doesn't create new money. Somebody has 1,000 ounces of gold, puts it on deposit at the bank, gets a checkbook, let's say, and is going around town writing checks. All he's done is change the form of his money, if you will, okay? Or he's just changed the way that people have access to it, but there's still just 1,000 ounces of gold. Let me, I know some people have been raising their hands. The sort of convention, Mark probably should have said this, normally we don't take questions in these opening sessions, and then later in the week we do. I think the reason is that here, there's a lot of people that's on camera, and it would be really embarrassing if I didn't know the answer. But later in the week, when we break out, it's not as big a deal. But in all seriousness, it's because we don't want to, if I start answering questions, then, chaos breaks out. We don't want anarchy. So I'll be hanging around up here afterward if you want to ask questions. Okay, so that's the rationale. Now, so in the checking account, that doesn't create new money. It just sort of changes the form of the money. If this moment you've got, 10,000 ounces of gold or 10,000 pounds of gold in this community, and now all of a sudden you introduce checking accounts, like some merchant or some entrepreneur starts a bank and is doing 100% reserve banking, we don't have to worry about, what happens to the money supply now? It's the same, okay? It's just whatever, if it's gold, it's whatever gold is being mined and brought into circulation that way, that's what it is. And the same thing with the savings accounts, again, that doesn't create new money. So it's true, people might think, well, wait a minute, if I go and, like the home buyer gets a $200,000 mortgage, surely that person has $200,000, they can go buy a house that's pushing up home prices. Isn't that going to cause price inflation? There's more money chasing the same amount of goods. Won't that push up prices? No, because where did that $200,000 come from? Again, if it's 100% reserve banking, it came from somebody else in the community that had or various people that collectively put aside $200,000 that they are not spending and pushing up prices. So it's just changing who spends the money. So yeah, it might push up home prices, but some other prices somewhere are going to be lower than they otherwise would have been because those savers aren't spending that money on consumption or even spending it on buying tractors or whatever. Okay, so again, it doesn't pure banking with 100% reserves does not affect how much money is in the economy. Okay, but fractional reserve banking does. So we got plenty of time left. I'm going to walk through this example a little bit slowly to make sure you get it. If you don't quite grasp this, with some people, fractional reserve banking is a little bit abstract. On Mises.org, I have a daily article that ran fairly recently. I think it's called the Fractional Reserve Banking Question, or the Question of Fractional Reserve Banking, something like that. And I'm taking these numbers from that article. So if you get a little lost here or you just want to go see it when you have time to really sit and ponder, then that's on Mises.org. So here, let me just make sure I don't forget to give you the punchline. Fractional reserve banking does increase the money supply. And so, again, to make sure you get the connection with the broader Austrian point here, this is why it's important, because by increasing the amount of money that's being lent out in the credit markets, it pushes down the interest rate. And so, as we'll see this in a minute, in this concrete example, but the idea is the interest rate no longer corresponds with how much genuine saving is going on. That remember, under 100% reserve banking, if somebody's going to the bank and getting a loan, it's because somebody else in the community refrained from consumption and made those funds available. Whereas we'll see in fractional reserve banking, that's not necessarily the case. And so if a bank's lending out more money at a lower interest rate under fractional reserve banking, and so business people are getting loans to go invest and expand their operations, it's not necessarily the case that there's somebody else in the community whose consumption is lower to make that physically possible. And that's where the trouble comes, and that's what Roger Garrison is going to talk to you about. Okay, but for this example, and let me see if I can make this bigger. Wrong way. Okay. I'll read this stuff I don't know if the people in the other room are going to be able to see. Yeah, that's kind of big. Okay, so now don't freak out. Just a confession, I used to read this stuff. If you read even something really crystal clear like Rothbard's Mystery of Banking or The Case Against the Fed. So incidentally, if you haven't read those things and you want to know more, those are really just phenomenal books. So start with Rothbard's The Case Against the Fed. It's a very slim volume, and it's amazing. Like he talks about the theory of banking and how it is that and what it is that central banks do and why they're bad. But then he also gives the history, and you see that it's not, when the Federal Reserve came into existence, it's not because there were a bunch of academics sitting around saying, oh, how can we help our fellow men? Let's invent a central bank. And that out of the goodness of our heart. That's not what happened. It was a bunch of politically connected, really rich guys that had mustaches they twirled and so forth. And they were in a back room with cigars. And Rothbard even gives the type of cigars they smoked. Not really. And that's how the Federal Reserve was created. Okay, so it's sort of a 1-2 punch because some people, they don't care about I don't want to hear about a conspiracy theory, or it doesn't matter what the motivations were of the people. What's important is was the act a good idea or not, the Federal Reserve Act. And Rothbard shows you, well, no, it was horrible, and he gives you the economic theory. But then some people also, typically it happens with a lot of leftists, I would say, or just in my experience, they're against the Federal Reserve, and I saw this too. I was at a End the Fed rally in Nashville. There was a Federal Reserve office there, and we went down there, and I was in my counterculture thing, I had my cap on, I had a bullhorn, and I was going, End the Fed, and it was awesome. I was getting tattoos and everything. It was great. And a lot of, and I was going to say a lot of people there, but that would suggest there were a lot of people at the rally. There weren't. A high fraction of the 6 of us who were there I wasn't expecting an applause there. It was clear, I'll put it this way, it was clear there weren't a bunch of people there who were thinking, I can't get to sleep at night worrying about the violation of private property rights. And I can't get to sleep at night. That's not why they were there. They didn't care about private property. They cared about, there's these rich bankers that are ripping us off, right? That was the thing that was, and one of the guys' signs, there are cars going by, and everyone's like, what are these losers doing outside the Federal Reserve building? And one of the guys' signs was saying that, the Fed is a private institution that's privately owned or something like that. That was the whole point of the person's sign, to convey to us how evil this thing must be because it's privately owned, right? And so normally, you wouldn't say, that grocery store is privately owned, boo, But I understand, I think I get the logic there because we are taught that the Fed is this, public institution that's there for our own good, and they're just the wise overseers to manage the money supply using the modern tools of scientific macroeconomics and so forth. And yet when you find out that actually it's a little bit, it's not quite that picture, that it's actually there's private people who own it and they benefit from it in certain ways, and it was a bunch of rich bankers who were originally in cahoots with certain senators to push the thing through, then it's well, wait a minute, that's sort of odd. That doesn't really fit the picture that I've been taught. And so anyway, the point is Rothbard's book, The Case Against the Fed, he gives you both there because some readers are going to just be drawn towards the pure economic analysis, whereas other ones, they want to see the conspiracy theory. They want to see who actually was behind the creation of the Fed, and that sort of suggests to them, okay, well maybe this thing isn't as noble as we've been taught. Okay, fractional reserve banking. Let's walk through this example. Now, where I was going with that long tangent was a few years ago when I was reading Rothbard's books for the first time, when he would get to this part with the balance sheet, my eyes would glaze over just because I didn't really get accounting at that point. I didn't know what he was talking about. So here, don't be intimidated. It's not a big deal. It's just showing you the left-hand side has assets. That's just saying what are the assets that the bank owns, and the right-hand side is the liabilities, meaning what is it that a claim against the bank? What do they have to worry about that there's something a claim against them? And then the shareholders' equity, because the two sides have to balance. Everything on the left-hand side has to equal the total on the right-hand side. And so a lot of times people say, oh, it's just assets and liabilities. But if you think about that, well, then what's the point of, if your assets are always balanced by your liabilities? But if one of the liabilities is what your shareholders own, well, then you can see how yeah, if you get more assets and you don't have outside creditors that have a liability against you, the difference is like what your shareholders, like their claim on the assets. And so if that goes up, the shareholders are better off. Okay, so that's the idea. So it always is going to balance, but we'll just walk through, because I think I didn't really get fractional reserve banking until I walked through an example like this. And so that's what I'm going to try to convey to you guys. And again, if you get lost, just go to that Mises.org article when you have more time to think about it. Okay, so the story behind this is there's this guy, Billy, and he's rummaging in the attic, and he finds, he's opening his grandpa's stuff, and he finds $1,000 in cash. All right, and I'm using cash instead of gold because I just think, at least for Americans, it's easier to think, it sounds more real, and you can really understand what's happening if you're using in terms of dollars. All right, so he's got $1,000 in actual currency, $100 bills and so forth. So he goes to his bank, and he deposits it there. So at this stage, this is the bank's balance sheet. What does its balance sheet look like? Well, it's got $1,000 in the vault, right? Because Billy gave him $1,000. They went and put it in this big vault and locked it. But then their liabilities, Billy opens a checking account, and the bank says, okay, you now have $1,000 on deposit with us. So, Billy goes around, he can write checks for up to $1,000. If he checks online and says, how much do I have with this bank? It'll say $1,000, right? So from the bank's point of view, that's a liability because there's somebody out there who has this legal claim on $1,000 of the bank, okay? Okay, what's the next step in the story? Is that this businesswoman, Sally, comes up to the bank and she wants a loan. And they give her a loan for $900, and she's going to use it to improve her business. She's got to go to Home Depot and buy some tools and so forth. And she doesn't really matter what her business is, but the idea is she needs a loan to expand her operations. Okay, so after the bank grants the loan to Sally, this is what its balance sheet looks like. And in case you can't read it in the back, it says in the asset side, $1,000 in vault cash, in a $900 loan to Sally at 5% interest for 12 months. Okay, so that's an important point there, that from the bank's point of view, Sally's loan is an asset, right? Because Sally owes them that money, so they're going to hang on to that. If some intern lost that documentation, the bank would be mad because now they wouldn't be able to prove that Sally owed them money, right? Because Sally, when she got the loan, had to sign a bunch of papers. So from the bank's point of view, that's clearly an asset. It's liabilities, though. Billy still thinks he's got $1,000, right? Billy has no clue what's going on with Sally. He says, no, I gave you guys $1,000. You gave me a checkbook. I got $1,000. So that's still a liability. And now Sally has a checking account with that bank, and her balance is $900, right? Because from her point of view, she went to the bank, applied for a $900 loan, and they said, okay, you're approved. All right, so now Sally, of course, knows in 12 months she's got to pay it back, but right now she's walking around, she goes to Home Depot, and she can write checks or slide her debit card or whatever, and she has up to $900 on deposit with this bank. Okay, so notice it's $1,900 on both sides, all right, because the market value of the loan to Sally at the moment it was advanced is $900. Okay, so that's pretty straightforward. Okay, now what happens? Sally goes to Home Depot and she spends all the $900 getting equipment for her business. So what happens from the bank's point of view? So here is we have to fill in a part of the story. Sally writes checks. She gives them to the cashier at the end of the week or whatever their clearing operation period is. What does Home Depot do? Well, it's received a bunch of checks from people. So what does it do? Home Depot is not going to sit on a personal check for $900 written from this woman, Sally, right? They're not going to be able to pay their employees with that. They want to turn that into money. And so assume that Home Depot is not a client of the bank where Sally went to get the loan and that Billy put his deposit in. Home Depot is going to give that check to its own bank. And then Home Depot's bank is going to talk to Sally's bank and say, yeah, we've got a check written on you guys for $900, so here you go, and we want the cash. All right, so in practice, of course, what the banks do is they just do net operations, right? So if Sally's bank had $1 million in checks written against this other bank, and then that bank had $1,900,000 written against this bank. It would just be the net difference. Okay, but the idea is we're holding everything else constant and just looking at this particular transaction. Because of Sally getting that loan and then writing checks at Home Depot, eventually the chickens are gonna come home to roost, and the bank who made that $900 loan to Sally is gonna have a redemption claim on it. And so when the smoke clears from that, this is where the bank stands. Again, notice it's $1,000 on the left and $1,000 on the right, but the composition of the assets now, instead of having Billy's $1,000 in cash that he originally deposited, now the composition of those assets have shifted. It's just $100 is what's left in the vault, because again, they had to give $900 in cash to the bank where Home Depot banks because of that $900 check. All right, so because remember that the check or bank note, if you're using a bank note, it is a claim saying we, the bank, will pay you this cash upon demand. All right, so if they don't want to go out of business, or they don't want the community to get the idea that they're not good on their word, they have to meet those claims. Okay, so that's what happens. So Sally right now at this point has nothing in her checking account, so there's no liability there, but Billy still thinks he's got his $1,000. He probably imagines that he's got $1,000 in the vault, but he doesn't. Now it's only $100 in the vault. The bank is still fine, though, from their point of view. They're saying just as long as Billy doesn't try to take out all his money, we're fine. If he goes to the ATM and takes out 20, we might be okay or whatever, but as long as he doesn't want to take out $800 or something, we're okay. And we've still got that. Sally still owes us $900, so the bank still thinks that they did a smart thing. Okay. In case you're getting antsy, we just have one more step after this one. Step 4, this is the bank's balance sheet after Sally sells her products for $1,000 in cash and deposits the proceeds in her account. All right, so the reason we got to do this step in the story is because I have to show you how is it that Sally's going to end up paying off the loan. So we have to assume she spent $900 at Home Depot. Whatever she's doing, her business, she makes the supplies, whatever, sells the products to her customers, and now she has $1,000 in revenue. Well, what's she going to do? She's not going to put it in a piggy bank. She's going to go put it in her checking account. So when the smoke clears from this, what happens? Again, notice it's $2,000 on the left and $2,000 on the right, so the balance sheet still balances. But now the bank has in its vault $1,100 because, again, we're assuming Sally sold her products for cash, that her customers gave her cash receipts, and so she had an extra $1,000 and she went and put it in the bank. Okay, last step of the argument, or of the story. Oops, sorry. By Friday, I'll get this thing timed perfectly and I won't keep advancing it past the projector. So here, what's happened, Sally paid off her loan plus interest. So it was $900 at 5%, so that's $945 that she owed, right? Because she originally borrowed $900, but it was 5% interest. So she owed the bank $945 to clear her obligation to the bank. And so we're assuming that she did that. Let me actually leave the other one up there. It'll be easier for you to see the contrast. Okay, so what happened is Sally originally had $1,000 in there, and in a sense, you can think of it, she wrote a check. She got the thing in the mail from the bank saying you owe us $945, so she wrote a check to the bank. But from the bank's point of view, she's writing a check on her own checking account with them. So how does that clear? All they do is they just subtract it. So instead of Sally having $1,000, now she's only got $55. That's that middle item on the right-hand side now, on the bottom. Okay? And then the loan to Sally, the thing that was on the asset side at stage 4, that's now gone because she paid off her loan. So the bank can't count that as an asset anymore because it's gone, it's matured. So you say, well, what's the point? Why did the bankers go through this rigmarole? Because look at what's going on. There's $1,100 in vault cash still, right? Because Sally just writing the check for $945 doesn't change how much cash is sitting in the vault. But if you look at the bank's liabilities, Billy still thinks he has $1,000, so $1,000 of that is his. And Sally still thinks she has $55 because she deposited more from her business than she needed to pay off the loan. So she still thinks she's up $55 from her taking out the loan and selling stuff to her customers. But that's only $1,055, and there's $1,100 in the vault. So the balance, that $45 now, is the bank's free and clear. Okay, and if you think about it, that's not a coincidence. The 45 is what? That's the interest that the bank made on the loan, right? Because it $900 principal and then $45 in interest payments. All right, so from the banker's point of view, they earned $45 over the course of the year because of that $900 loan that they advanced. So that's why banks like fractional reserve banking, because they earn interest. And if you think about it, well, let me back up for a second. So money really was created in this whole process, specifically the $900 that was advanced to Sally. Because remember, Billy found that $1,000, and he's walking around town thinking he's got $1,000, and then Sally gets a loan for $900. And you say, well, where'd that $900 come from? In a sense, if you want to, you can say it came from Billy, but he still thinks he has $1,000. Right? So that's different from the 100% reserve banking case where if Billy bought a CD and paid $1,000 for it, he wouldn't be able to spend that money. Billy still thinks that money is his. It's just sitting in his cash balances. And then Sally has this additional $900. So in that respect, $900 in new money really was created in the community. And then when Sally paid off her loan, that $900 disappeared. The money supply shrank. But the 45, in a sense, if you want to think of it like this, that was money that was already in existence that the bankers, through this magic trick, have somehow, it's ended up in their pockets, right? So that money was out there. Strictly speaking, it was in the pockets of Sally's customers. Then she created valuable goods and services that they wanted. They voluntarily gave her the money. And then out of that, 45 of it, Sally made as a side payment to the bankers saying, thanks for giving me that loan. Thanks for creating money temporarily for a year and then extinguishing it, and I'll give you $45 because you did that for me. And so that 45 has somehow gotten out of the pockets of the people in the community and into the banker's possession. It's in their vault now, and they don't have any liabilities. They don't have any claim on that. It's their money free and clear because of they created money out of thin air and lent it to Sally. Okay, so that's why fractional reserve banking is profitable or lucrative from the banker's point of view. So this goes back to the goldsmiths were the ones who actually started this, and the idea was even when people are using gold, they were like the first bankers in a sense that people would. So if you're a goldsmith, you're using gold in your business. You obviously have to have a safe and so forth because part of your merchandise is really valuable. So they realized, well, we can expand our operations and we'll accept deposits of gold from everybody else in the community for safekeeping. And then they're sitting there realizing, and they'd give tickets to people for redemption claims. And then they realized, of course, that on a given day, we got a bunch of gold sitting in our vault. And what are the chances everyone's going to show up and want their gold at the same time? So some people who are devious might think, you might say, oh, well, what do they do? They started like secretly taking gold out and buying stuff with it. That would be kind of foolish because, then their stockpile would keep shrinking and they would just be getting more and more precarious. Instead of doing that, the smart thing to do is just to lend it out, to take, 10 ounces of gold that technically is customer Joe's, but Joe's not going to show up and want it, or even if he does, you've got 100 other customers and they're not all going to show up. So you take the 10 ounces of gold, you don't go spend it. What you do is you lend it to somebody and say, I'll give you this 10 ounces of gold, but in a year you owe me 11 ounces back. And so as long as that person doesn't default on the loan, you get the 10 back and you put it back so your stockpile is still what it's supposed to be, but then that extra interest that you got paid, that ounce of gold in that example, is yours free and clear. So then you can go spend that and there's no danger, right? So the only danger is with fractional reserve banking is either if you make bad loans, so you lend out some of your customers' money, and then the person defaults, and then you got a deficiency there, or if there's a bank run, if everyone just shows up and wants to take the money out at the same time, obviously you can't satisfy everyone if you're engaging in fractional reserve banking. So those are the two problems with fractional reserve banking, and it's because of those reasons that fractional reserve bankers have turned to central banks. So got about 10 minutes here. Let me very quickly explain to you the limits of free market fractional reserve banking, and then you'll understand what it is that central banks do. So when you walk through that example of fractional reserve banking, it seems as if, well, wow, I mean, this money from nothing. Why don't bankers just create, why stop at $900? Why doesn't that bank create $1 trillion and lend it out to Sally and everybody else in the community and make, instead of making 45, they can make $45 billion? Well, the reason they don't do that is, remember that one step where Home Depot gets the check and then it comes back and then the bank's vault gets depleted. It went from having $1,000 in cash to having 900 or having 100. That's the problem. Any individual bank, whether it's using gold as money or using paper currency, if it expands too quickly, if it engages in too much fractional reserve banking, if it makes too many loans based on an original deposit of actual money, well, then it's very risky because people are out in the community spending that, and the idea is the clients of the bank that's been expanding, when they interact with other people in the community, that's going to mean that those people's banks now are going to have more and more of a net claim on the expanding bank. Okay, because remember, in an economy, not everyone is a client of the same bank. So even if every merchant accepts checks at par, meaning they don't worry about the solvency of the bank, like if you walk in and write a check for $100, that's as good to the merchant as $100 in cash. Even if every merchant's doing that, still, if one particular bank is expanding more than the other possibly fractional reserve banks in the community, the amount of spending done by that bank's clients is going to be bigger than the clients of the other banks. It's like that bank's clients are going to run a trade deficit with everybody else, if you're understanding that metaphor. All right, so the idea is, on net, those redemption tickets are going to flow back to the expanding bank, and then the reserves are going to get depleted. So if we're talking about U.S. dollars, the cash in the vault eventually is going to hit zero, and then somebody's going to say, hey, somebody wrote a check for $50, we want it, and they're going to have to say, sorry, we don't have it in the vault, and then that bank's finished, because they have to at least keep the illusion up of being able to redeem things. That's the only way people are going to trust that bank, even if it's engaging in fractional reserve operations. As long as people can always get their money when they show up and want it, people say, oh, okay, well, that's fine. That's really all I care about. I don't really care what they're doing behind the scenes, as long as I can always get my money when I want it. All right, so that's the idea. So in a free market, and there's, I don't have time to get into this, but just to make you aware of the fact, Rothbard and a lot of people in that tradition think fractional reserve banking per se is fraudulent, whereas there are other Austrians people like Steve Horowitz and Larry White are two big names in that tradition. They subscribe to what they're calling free banking, and they think that fractional reserve banking is fine so long as it's done in the marketplace and not propped up by government intervention. All right, so like I said, I don't have time to get into that debate. That's one of the modern debates when Austrians feel like engaging in a blood sport. That's what they argue about. And if you're interested, just ask Joe Salerno. He's one of the gladiators in this particular arena, and he'll give you what you need to get up to speed on that particular argument. All right, but that's one of the things they argue about. So both sides agree that in a purely free market without the government intervening, there would be limits on fractional reserve banking. All right, and again, because if one bank tries to expand too quickly, it's going to get hit with these redemption claims, and it's going to run out of its reserves really quickly, and then it's going to be finished because no one's going to trust that bank anymore. It's going to lose its reputation. All right, so that's the limit in a market economy. Now Rothbard's going to say, sure, there's limits, but that's like saying in a market economy, a restaurant that would go up to the diners and chop off their thumbs, that's not going to stay in business very long. But still, chopping off your diner's thumbs would be fraud, or not fraud, it would be theft or crime, so aggression. There you go. That's the word I'm looking for, right? So the fact that there's market penalties for stealing from your customers, that doesn't mean it's okay, is Rothbard's point. That, yeah, sure, there's limits to it, but it's still fraudulent, just like in Rothbard's view, if you put your couch on deposit, storing it at a place because you went home for the summer and then came back and found out that the guy had lent it out, you would be outraged. And it wouldn't matter if he said, no, but I had it back in here in time for you to start school. What's the big deal? right? You would say, but I thought that's what our arrangement was. So that's Rothbard's take towards fractional reserve banking. He thinks it's inherently fraudulent. But in any event, every Austrian agrees that in a pure market with no government favoritism to banks, there would be strict limits on that. So if you think about it from the banker's point of view, how do they get around that? So there's two things they're worried about. Again, they're worried about there being a run on the bank if the community gets the idea in their head that the bank's not sound and all the depositors line up and want to empty out their checking accounts, then the fractional reserve bank is finished. And the other problem is, less dramatically, just in the normal course of operations, if one of them expands too quickly, it's going to get hit with a bunch of net claims on redemption and its reserves are going to run out. So central banking gets around both of those, or it mitigates both of those. So on the one hand, I should say central banking and deposit insurance, what in the U.S. is called FDIC. Because there, what happens, the government, and this was instituted in the 30s, FDIC, the government says, we insure your checking accounts. I think it used to be $100,000. I think now it's up to $250,000 in every checking account. The government guarantees. So even if your bank fails, if you're an individual and you had a checking account with that bank, the government promises to make you whole. So why do they do that? What's the whole point? Is because now, even if you think your bank's in trouble and you hear rumors that they made a bunch of dodgy loans or whatever, you don't really care. You don't think, oh my gosh, I have to get over there first thing in the morning to take my money out, because even if it fails, the government's going to make me whole, so I don't really care. So because of that, the banks now can engage in riskier operations, since there's that check of the consumers showing up and wanting their money back is sort of mitigated. But perhaps more crucially, what central banking does is it forms a giant cartel of the banks. That now the banks, if they can expand in unison, then this issue of one bank expanding too quickly and then getting hit with net redemption claims, that fades away if all the banks are expanding uniformly. Because my customers are spending more money on this bank's clientele, but by the same token, that bank's expanding too, so their customers are spending more money on these people, and so in the clearinghouse operations, they just cancel out on average. So that's the idea. And if you in a free market, you might have thought, well, wouldn't the banks have colluded and tried to do that anyway? Yeah, they might have, but then there would always be room for some new bank to start that has a higher reserve. So if you got banks, and originally they were all 95% reserved, and they all huddled in the back room smoking cigars and so forth, and said, hey, why don't we lower our reserve ratios to 20%, and then think of, we'll all be able to expand our loan operations, and we won't sort of be picking each other off, or won't be cutthroat competition, and we can all basically bilk the community together. And they'd say, that sounds like a good idea. They start doing that, there would be room in a completely free market for somebody else to start up a bank that has 80% reserves. And then that bank, as it gained clients, those clients over time would be receiving net payments from everybody else because that bank was more conservative. And that upstart bank would eventually siphon off all the reserves from the banks that were having 20% reserve ratios. Okay, so that's the problem. In a free market, it's hard to engage in massive systematic fractional reserve banking because there's always the threat of competition coming in. So under central banking, just think about what central banking does. It regulates entry into the banking industry. It imposes uniformity. It sort of gets around that problem, that all the banks, in a sense, are put in the same system, and it's a giant cartel. So the banks have the government sort of policing the cartel and walking around, and if any one bank gets out of line, just gets whacked down back into place, so they all can inflate together. That's from a Rothbardian point of view, that's what the function of central banking is. And also, you say, well, why is it in the government's interest? Because that's clearly benefiting all these private bankers. Well, the government benefits too, because historically, one of the other functions of the central bank is to be sort of like the banker of the government. And so, I only got a few minutes left. If you want to see this discussed more fully, it's trying to think of what it's called. How Bernanke's using the printing press to win friends and allies, or something like that, is a talk I gave at a recent Mises Circle. If you go to Mises.org, the media, and look up my archives, there's a talk there that I gave, and I walk through that. And you'll see how is it that the government benefits from the the existence of a central bank. So thus far, I've explained to you why the bankers like it, but also the government benefits as well. But that's what we're out of time there. So in conclusion, what you need to realize, again, the big picture and why this is relevant for the next lecture you're going to hear is when the banks can engage in fractional reserve banking, in a sense, in a very genuine sense, they create money out of nothing. That floods the loan market. I didn't point it out in this numerical example, but there, when the bank's going to give the loan to Sally, if they had to rely on funds from people buying CDs and making genuine savings deposits, the interest rate would be a certain height that they would have to charge Sally. But if they can just create money out of thin air, if they can just, on their books, say, okay, Sally, you now have a $900 balance with us, and that $900 didn't come from somewhere, well, they can afford to charge her a lower interest rate. All right, so the interest rate that business people like Sally gets charged is lower because of fractional reserve banking, and then Garrison's going to tell you why that's bad. All right, thanks.